Hi, this is Manfred of Map Partners. Just a follow-up to our recent video on making money in falling market series that you may have seen recently. Today I would like to walk you through a live example using our in-house 4-stage process on how we identify investment opportunities, what sort of validation do we go through, both fundamental and technical, and the risk management that we put in place to ensure that there are no unintended bets and portfolio positions do reflect the underlying risk and reward profile. A position we initiated at the tail end of last year was to short Nasdaq 100. If you cast your mind back, Nasdaq was riding high, although the talks of Fed raising rate had been rumbling on throughout the year, and there was a bit of correction at the beginning of first and second quarter of 2021. We must, however, emphasize that we're not quant shop, but we do use a number of tools to monitor both high and low frequency data. In this case, as you can see from the blue arrow, we note that the positive uptrend was gradually built up in the third quarter of 2020. That is when the reopening trade started gaining the momentum. This was at the back of support from the US government fiscal subsidy, i.e. the CARES Act and the Federal Reserve Primary Market Corporate Credit Facility. This price appreciation was actually picked up with a higher valuation, i.e. the orange arrow here, something like 6 months later. Give or take, valuation has risen about 1 standard deviation after price initially breached that threshold. So was it the right time to initiate a short position in 2020? The answer was no. Just because it had risen doesn't mean it will fall back. Contrarian for contrarian sake is not a good investment principle. The market can remain irrational longer than you can remain solvent. You will have missed out another 15% gain, 18% to be precise, to its peak, if you did sell out as soon as triple Q move about 1 standard deviation. What we needed was a catalyst. Just because ideas thrown up by charts, they do not necessarily mean that they will work. We do need to do some checks and balances to make sure the ideas are sustainable. So here, what we're doing is to take a broader view of the market. We are mindful of what happened in 1999 when tech bubbles built up. So we take a broader market perspective to ensure that we're not blindsided by one set of data. In this case, all tech-oriented and growth-focused companies invested within the Nasdaq universe. Here, we're looking at the valuation of triple Q. In short, they're the new economy stocks, a proxy for Nasdaq 100 stock, and that of the Dow Jones Industrial Average, the old economy stocks. So the higher the ratio, the more expensive the new economies companies are, being priced relative to the older economies companies. One caveat though, fully appreciate that the constituents of both indices would have changed over the last 20 years, but the principle is still the same and the comparison here is valid. If you look across in October 2021, triple Q over Dow ratio stood at 2.8 times standard deviation above its mean. Put that into perspective, the ratio was 2.25 times above its standard deviation in 1999 when we had a tech bubble. And as it stands, beginning of this week, the same ratio was 1.4 times. That's well and good, but it still doesn't tell us we should short Nasdaq 100. Our view changed with the following 2 key noteworthy events in 2021. First, inflation was edging up when the economy in part opened up. The supply chain issues, port delays all added to the chatter of high inflation. But Fed was dismissive and described the inflationary pressure was transitory. In fact, as we can see at the blue line, on the contrary, real rates actually bottomed in June 2021. This is a huge warning sign. Secondly, the confirmation or the catalyst that we're looking for came with Fed's November minutes issued in December. Fed decided to quicken the wind down of their bond buying stimulus program. That was earlier than planned and offers the most concrete sign on how J. Powell's focus is shifting towards preventing high inflation. For your information, the PCE core inflation, excluding food and energy, at the time was 3.2%, and that equivalent now is 4.5%. Clearly, it was the beginning of the end of Fed's view that inflation was transitory. As you can see from previous slide, we're ready to pull the trigger to short Nasdaq 100, but our process includes some checks and balances to make sure we get the best bang for our bucks. What does that mean? First of all, we need to check whether the fundamentals stacks up. This means company's operation, earnings, and ultimately the share price performance. Put it into the context of earnings growth and market multiples. Say, in the last 5 years, Q has been produced an annual return of about 12%, or you take a longer time frame, 20% per annum since 2010. If you break down the performance driver, there are two elements to that. One reflects the underlying company's earnings, here in orange EPS growth, and the other is more emotional driven on the multiples, i.e. in green, that investors are prepared to pay for $1 future earnings. I'm pleased to say in the last few years, Nasdaq share price has been rewarded by the underlying company's earnings, and multiples have not been too much of a bigger driver or pose adverse impact. Of course, this year, 2022, we see multiples contracted as the discount rate move up with rate rises and investors fleet risky assets. Our fundamental stress test look at what an asset would be for a given level of earnings growth and multiples that investors are prepared to pay. For example, Q, Nasdaq, was around 16,320 at the end of 2021. And if future earnings grow at 20%, that's the historical average in the last 5 years, and investors are prepared to pay plus or minus 10% premium or discount to those companies, the starting point for Nasdaq to trade at in 2022 would have been in the range between 17,625 and 21,542, those figures in the red boxes, or the range would have been 16,156 and 19,747, again the numbers in red boxes, if I use the sell side 2022 consensus earnings growth number. Given what I have mentioned on the headwind posed by rising rates, it means a tighter financial condition, and that will not bode well with the earnings outlook for 2022. Our more conservative earning estimate would therefore be between 10% contraction and 5% growth, and multiples would be between 10 and 20% compression, although the latter is more likely given our past empirical experience. So our base case of the target Nasdaq in 2022 to be between 11,000 and 13,000 for the round number, i.e. here numbers in red within the yellow highlighted boxes in the chart. So after taking all this in consideration, we place a short position as a portfolio hedge at the end of December 2021. So where are we in terms of our short position in Nasdaq 100? Given what we know, and if anything that has changed our mind in terms of Nasdaq 2022 target would be the pace and magnitude of monetary tightening as well as the underlying inflation numbers. If you look at the GFC experience, i.e. the global financial crisis, the peak to trough of the current Nasdaq correction is in the ballpark of 28%, so more or less the correction has been priced in. Our conservative 12-month estimate of Nasdaq will be between 10 and 12,000, i.e. here the numbers inside the yellow boxes, with earnings growth at best 5%, and that means there's certain earnings resilience in certain sectors, example in the energy sector. We therefore maintain our Q hedge position and seek to reduce as and when real yields stabilize, and or when Fed hit the target rate, say 100 basis points from here. Apart from the fundamental assessment, we also use technical to help us better time our entry and exit, in particular momentum is at play or not. Basically, we focus on any potential inflection point, whether support and resistance are in place across both long-term and short-term. All in all, we're trying to assess whether it makes sense to take on risk or risk trades. In this case, we'll talk about adding or initiate a short position of triple Q. In the short term, as highlighted here by the blue arrows, upside support are in place if Nasdaq manages to stay above 11,700. So what does that mean? Any upside to short the Nasdaq 100 probably would be capped. Finally, we also take a look to see where our portfolio individual position may have positioned against the consensus view and what crowded trade may have been. For the record, the year-to-date crowded trade would be inflation, global recession, just a few for us that we've been talking about over the year. So our 1-year-old Nasdaq short would be a crowded trade. In brief, the upside for our hedge position, Nasdaq short, may now have been capped. In summary, investment opportunities do exist in both rising and falling market. I hope this message has come through clearly in this and previous video of the series Making Money in Falling Market. Inverse ETFs do provide investors another dimension of portfolio management, and in order to capture this performance persistently, you do require a systematic way to generate ideas. With those ideas, it needs to be validated and assessed. And don't forget, there's risk management to put in place. Once again, I hope you found this working example of shorting is useful, and please follow our video to another interested party or sign up my YouTube channel for reminders and future updates. Happy investing!